Good morning, North America, from beautiful Victoria, BC. So today we're going to talk about how to rebalance our portfolios for the defensive. So we wake up this morning to another miserable day in the stock market. There's even an article out from JP Morgan saying time to sell all your crypto, which I somewhat disagree with. Depends how you define crypto. I'm not selling my Bitcoin, so there's that. But yeah, if you have any other crypto holdings, might be worth considering. Anyway, so let's talk about the matter at hand here. We need to, or at least I am personally, and I have been doing this for a while, I've been shifting my portfolio to a defensive position. And this is just to offset these upcoming extended recessions and maybe worse that we're facing there. So from my particular research, we are looking at value stocks and emerging global markets as some of the opportunity sectors in the next 2 to 3 to 5 years. And conversely, we're looking at weakness in growth stocks and high risk stocks, innovation stocks, like ARC Innovation, high risk technology stocks. Companies that aren't making money are not going to do well in a recession. It's going to be what they call the cash cows, the companies that are so big that they're going to continue to make money. They have essential services. Companies in retail like Walmart, Coca-Cola, companies in energy sectors, utility companies that own pipelines. I mean, people need energy, people need utilities, people need consumer staple goods, and those sectors are going to continue to hold steady. So what I personally like to do in my portfolio is start shifting to defensive dividend giving ETFs that consist of those kind of stocks. So like a global energy stock, like on the Toronto Stock Exchange, HUTL, those typically are going to stay steady. That one in particular has an 8% dividend. So I'm going to continue to get a 8% dividend on my investments all throughout the recession, or so I hope at least. So that's what I mean when I say it's shifting to a defensive position. So another thing to consider is doing this rebalancing slowly. So this just means maybe if you have a stock that you think is just going to take a loss because of these new market conditions over the next 5 to 10 years, but you still believe in it fundamentally, you don't need to sell all of it to rebalance. You could sell 1/5 of your shares of it and just trim it a little bit, start slowly building into a more defensive position. Because if you feel like I do, an aggressive position or a high risk position is just going to fail at this time. So rebalancing into an even greater percentage of high dividend paying stocks slowly is my personal strategy for what I think is going to get me through these through this ongoing recession and this constant dip in the markets. And I just want to say one more thing. You could expect fluctuations. There are going to be tons of dead cat bounces, bear market rallies. So what do those look like? So the highs are never as high as they were before, and the lows go even lower. That's what bear market means. So you see, yes, stocks are always going to fluctuate. There's always going to be rallies. But they're not as good, so you end up losing money over the long term in cases where your stock is not going up as high as when you bought it over time on a trend. And so thanks to policy decision makers, thanks to governments that print money while at the same time hiking interest rates, we're in for a lot of pain, and they've literally just told us that we're in for a lot of pain over the next few years. Wish the best of luck to you all out there. It's going to be a tough market, but there are still ways to make money. There's always ways to make money. May the market force be with you.